Hello and a warm welcome to Econoday Unplugged on Wednesday, the 28th of July, 2021. Terry Sheehan is stateside, Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London. It might be holiday season, but there is, as they say, much to talk about this week with key data, central bank announcements, COVID, and even government borrowing, all capable of impacting market sentiment one way or another. So best we get on with it then. In recent months, we've seen some central banks turn down the QE tapering route, and in New Zealand, as Brian will be talking about, the RBNZ has already reached the end of that particular road. However, the blinding exception to date is, of course, the Fed. And so, since Mr. Powell and co have just wrapped up their July FOMC meeting, it's over to Terry to find out if US monetary policy makers are any closer to following the tapering pact. So, Terry, what did they have to say?
Well, very little.
Right, over to Brian then.
Well, they really did not give any strong hint about when they would start to taper. They did give very strong hint that they were talking about it. Chair Powell managed to be light on details about any possible tapering, but it does seem pretty clear that they are in the early stages of planning. Powell did mention that the one thing that he let on that they were talking about was that they don't generally see much reason to taper the mortgage-backed securities purchases faster than those of treasuries. Mm-hmm. But on the whole, it looks like monetary policy is data dependent, and if they find the substantial improvement that they've been looking for in the next month or two of data, then I think we will start to see the plans for the taper.
Okay, so it's data dependent. How about COVID dependent? Because some of the big news around the world at the moment, particularly my part of the world, and I suppose especially in Asia as well, are some of these COVID numbers starting to increase quite sharply again. How worried is the Fed about what's going on with the virus?
He was asked about that, and it does seem that they consider the risk to be a little more elevated, but he also very specifically said that that the Fed sees less effect from each wave of COVID, possibly with the exception of last winter before the vaccinations started to arrive. Businesses are adapting their practices to meet public health safety guidelines. It's uneven, but people are wearing masks. So it's pretty clear that the Fed sees less risk from COVID, but though by no means no risk from COVID.
Okay, fair enough then. Right, let's have a look at the state of the US economy. Where are we? Later on this week, we'll get the first look at second quarter GDP. What's expected there?
Another strong quarter. Consumer spending has been on a tear here, and that's been the main cause of growth in recent quarters, and it's expected to be maintained into the second quarter.
So it's mainly domestic demand driving the recovery then?
Yes.
Okay, fair enough. Sticking with, with that, certainly for the US anyway, government borrowing. The good old deficit ceiling expires again, the end of this week, if I remember rightly. Are we looking at potential for fresh shutdowns, with, apart from anything else, I guess, implications for our own data calendar, or is this just another proverbial storm in a teacup?
That's a tough question.
That's why we ask them.
But I think what we'll see is the usual evoking of extraordinary measures, and they'll manage to drag it out for a while, but as they have generally managed to do, they will finally reach a compromise. I think the political situation, although clearly fraught here, I think the Biden administration is better capable of reaching an agreement with the Republicans.
Okay, tell me, I've lost track of it all now, but where do we stand in terms of the latest fiscal stimulus packages in the States? Because they've been talked about for so long now, and certainly this side of the pond, we keep getting various reports suggesting that they're close to agreement, but it's less than originally thought, and then perhaps they're not agreeing with something. So what's the state of the fiscal side now in terms of actually providing additional stimulus?
Well, I think they will get a fairly large infrastructure package. It won't be as big as the Democrats wanted. But really, what it might be more interesting right now is the fact that these stimulus payments for families with children will be coming into the economies in the next week or so. The checks have already started to arrive, and we're likely to get a big boost from that.
Okay, so I guess then you're, personally speaking, you pretty optimistic about the outlook for the US second half of this year?
Generally speaking, yes. As long as consumer spending holds up, the job market continues to recover, we're actually in pretty good shape right now.
Actually, yeah, sorry, Brian.
What about the inflation outlook, though, Terry? I mean, how do you see that sort of stronger demand side flowing through into underlying price pressures?
I'm sorry, I didn't catch the first part of that.
Yeah, just the inflation outlook. How do you see that translating through to inflation?
I'm still not hearing you.
Okay, perhaps in case you can't hear Brian, you can hear me okay. Yeah, Brian was asking you, particularly talking about decent growth coming out of the States, domestic demand led. What do you think is going to be like in terms of the implications for US inflation going forward?
Well, we're already seeing signs of some of the upward price pressures easing. Certainly, inflation is well above what the Fed's target is at the moment. But things like, the surge in lumber prices has actually backed down some. Some of the surveys of manufacturing are showing that supply chains are improving a little bit. So a lot of the things that are really driving prices right now are getting better.
Okay, and I've got to ask you one last question, just sort of following on from that. I kind of playing devil's advocate, I guess. I mean, how far we've already got? What's US inflation at the moment? 5 point whatever it is percent. I can't remember. 5.4 is it? US
Something
inflation?
like that for the CPI, yeah.
Yeah. So, I mean, how far do you think the Fed could actually allow inflation to rise before it is almost seen to be having to do something about it, or it's going to start losing credibility for being too far behind the curve? Is there an upper limit to this, or is it still, we could see, let's suppose, I don't know, all prices go up again, we see 6.5%, but that's still going to be attributable to one-off factors, so don't worry about it. Or is simply 6.5% or even 7% simply too high?
Oh, absolutely too high. I think if the current things that are driving prices up, like motor vehicle prices, some travel costs, if those ease up soon and are not replaced by something else, I think the Fed will get the outcome they're looking for, in that upward pressure will drop back closer to their target. I think they might tolerate as much as 3% right now, but anything much above that persistently would be probably beyond what they would consider in line with their target.
Okay, excellent. Anything else you want from your side?
No, we're good here.
Great, excellent. Okay, thanks for that, Terry. Okay, then let's move to a different part of the world. Earlier this month, the World Bank revised down its forecast for 2021 growth for East Asia and the Pacific region, excluding China, from 4.4% to 4% due to spikes in COVID cases, new variants, and vaccine supply constraints. So, Brian, how bad is this COVID situation in the countries that you cover, and how much of a threat do you think it is going to be to growth over the remainder of the year?
Yeah, I mean, it's definitely picked up quite a bit right across the Asia Pacific region, over the last 2 or 3 months, and yeah, I think it's quite appropriate to adjust our sort of more optimistic forecast that we might have had earlier on in the year. We've seen that in a couple of cases from central banks revising down their growth forecasts, and it's coming through to the data quite noticeably. Particularly if you look at, say, the PMI surveys, quite a few of those have shown a slowdown in, a loss of momentum in whatever recovery we had going at the start of the year. So, obviously, we know about the really serious outbreaks that we had earlier in the year in India.
Mm-hmm.
We're all thinking about what's going on in Japan, obviously, how they're dealing with their outbreak ahead of and now during the Tokyo Olympics. And, it's happening in plenty of other parts of the region as well, particularly here in Australia. We're right in the middle of a Delta outbreak that's seen a large part of the country under pretty severe lockdown, including where I am here in Sydney. So, and again, also China, they've had an outbreak around the Pearl River Delta down near Hong Kong, which is a huge manufacturing and export oriented part of the country. So, I think quite appropriate to expect that we're going to have an impact on growth. The key question though is how do central banks respond to that? And for now, I think the feeling amongst many officials in this part of the world is, okay, we're going to see this impact the near-term numbers, but they're still expressing confidence that the longer-term outlook is still looking okay. I think the most explicit example of that is some of the comments we've had from the Reserve Bank of Australia. They've come out and said, yeah, sure, these outbreaks and lockdowns have a short-term impact, but the pattern has been that things bounce back pretty quickly once you get past the outbreaks and ease those restrictions. So we'll see.
How's the vaccine rollout? Because one of the problems, certainly, perhaps not so much for Australia, but certainly chunks of Asia has been relative sluggishness of the vaccine delivery, particularly compared to the likes of States and most of Europe. How's that doing now, or is that still a big issue?
Here in Australia, particularly, or across?
Well, just generally in your sort of region, ones you cover.
Yeah, I mean, obviously there's variation. I think it's going along. I don't have the exact numbers in all the parts of the region, but I think they are still progressing. And definitely here in Australia, there's been a bit of a slow start to it earlier in the year, but it's gaining momentum now as we get extra supplies. So that's obviously what a lot of authorities in this part of the world have banked on, that we're going to get the vaccine and then we can move away from this lockdown strategy and open up, because there has been definitely here in Australia a very low tolerance for sort of letting COVID spread, and almost a zero COVID policy is what authorities here are looking for. I think Singapore has a different tack. They've been sort of experimenting with trying to live with the virus and open up, and so there's a range of approaches being taken across the region, and I think the jury's still out about which one's going to be the best one.
Okay, thanks for that. Policy then.
But just
Sonia, please.
No, just briefly, as I said, officials here are definitely, I think, still reasonably confident about the long-term outlook, as I said. And what you're starting to see now is this show in the language that central banks are using. I think the New Zealand, the Reserve Bank of New Zealand is probably the most advanced down that
Okay,
path.
that's what I was going to ask you about.
Yeah.
Right, I saw some comments today from, was it the former Assistant Governor Grant Spencer?
Yes.
Just remind people that you now heard. Well, so the RBNZ have finished with quantitative easing now, and Grant Spencer today was talking about the official cash rate as high as 2% or even higher by the third quarter of next year. So do you think that's a plausible increase? And B, what are the chances we could actually see the first rate hike coming through at the August meeting?
Yeah, I saw those comments, and he's coming out saying August is definitely on the table, which is probably a little bit earlier than most people had expected. So it's I mean, he's saying that that's what he would do rather than that's necessarily what he expects
Right.
the RBNZ would do. So the jury's still out about whether they will go ahead with that. But they've definitely made it clear that the next thing that they're going to do is raise policy rates. They've ended their quantitative easing asset purchase program, and in the last statement back in earlier this month, they said, okay, when we decide that we need to adjust policy again, it's going to be the main policy rate that we hike to do that. So yeah, it's just really a matter of as Terry said, looking at the data, and I think that's what our friends over in New Zealand will do. So it could happen at least sometime in the next few months where they start to make that move. And so I think, as I said, they're probably the first advanced along that path here in the Asia Pacific region.
Looks most advanced along that path compared to a lot of central banks at the moment. Quickly before we move away from New Zealand, you're trying to say a possible hike in interest rates, perhaps as early as the August meeting. How does that fit in with possible quantitative tightening as opposed to easing? What are they going to do about the size of the balance sheet?
Yeah, they haven't really been explicit about their plans for that. So, but you would expect that would be part of the program over perhaps a longer term as well. That I'm sure they don't like being in the position that they are, and
right.
at the earliest opportunity they'd want to try and get back to a more neutral position.
Okay, fair enough.
And that's also the case here in Australia.
I was going to ask you that next.
Yeah. So, sorry. So,
no, please. It's all right. It saves me having to ask.
As we know, at the last meeting at the start of this month, the RBA started to scale back its asset purchases. Still continuing, and they'll review it again in November. But again, they're I think starting to make a move. And as I said, they're pretty confident that any impact from lockdowns will be short-lived once we can sort of ease restrictions.
So how far in terms of, I know, well, the RBA, we're not at that stage yet by any means, but how far behind the RBNZ do you think the Reserve Bank of Australia is in terms of potential interest rate hikes?
Well, if you believe what they've been saying, it's still quite some time away, because they're saying quite explicitly, and they have for probably 5 or 6 months now, that they're not really contemplating an increase in policy rates until, well, really 2024, or at least late 2023. So obviously circumstances can change and they can bring forward that assessment, but right now, they've been pretty consistent in sort of sending this message that okay, sure, we might start ending up the bond purchases and doing a few other things, but in terms of the actual main policy rate, they're not thinking of moving it in the next 2 years. So they are still quite some way behind where the RBNZ is. And they've also been very clear saying, we're not going to move just because we think inflation is forecast to rise. We're going to wait till we actually see it
rises
in that target range.
Right, quick last one on that side. Is it talking ignorance from from my side of my side of sort of UK, but is it unusual for there to be a big difference in the central bank cycles between Australia and New Zealand? So, for example, if we let's say we do see the Reserve Bank of New Zealand tighten next month, and we don't see the RBA go for, you were talking about 2 years or perhaps even longer, is that an unusually long gap? I mean, would the central banks be worried about implications for the exchange rate cross, or is that neither here nor there?
No, it would be. They do tend to have a fair bit of synchronisation, but not always. New Zealand is obviously a smaller country, probably more exposed to global trade to a certain extent than Australia is, but I think it's probably been exacerbated just due to the fact that they are less impacted by COVID at the moment. They don't have any outbreaks and restrictions. They're obviously more geographically isolated, so they've managed to escape some of that. So that's probably explaining to a certain extent why they're a little bit further advanced than perhaps they might normally be.
Okay, I'll round off your side with China if I can then.
Sure.
We had the cut in banks' reserve requirements the other week, but we didn't see any change in benchmark loan rates. So, I mean, is China slowing? And we might be looking at some kind of additional easing cycle from the People's Bank of China, or is it just a bit of sort of white noise and China's actually doing okay? What's going on?
Yeah, I don't think we can really form a very firm judgment based on just that one little adjustment to reserve requirements. They were pretty explicit trying to downplay that move when it came out, saying, "Oh, this is just a liquidity operation. Don't read too much into it." But you could definitely at least raise an eyebrow that they're still in this sort of mode of easing policy rather than starting to talk about tightening policy as we've seen elsewhere. But again, it's just a small move, and we would want to sort of probably see a little bit more data before they would make a firm decision to adjust policy. They're still sort of characterising their stances as prudent and still sort of talking about how they're trying to support the recovery, but not expressing great concern at the moment. But that being said, they definitely have seen a bit of a slowdown in those key PMI numbers, suggesting that there has been a loss of momentum. So I think that and this is also true for India, that they're in no hurry to start tightening policy. That's for sure.
Okay, excellent. Thanks for that, Brian. Right, well, I suppose to my part of the world then, we talked about COVID. Terry saying not too much an issue stateside at the moment. Perhaps Brian's part of the world are keeping an eye on it, but by and large not too worried about it. One central bank which is certainly taking it on board now is the ECB. Looking across Europe, the rising Delta variant cases in a large number of European countries now, to the extent that essentially it's forcing governments to introduce, what are effectively vaccine passports, not that they would dare call them that, which will bar entry to unvaccinated travellers, irrespective of EU rules for the free movement of people across the Union. So France, Germany, Netherlands, Portugal, Spain, all going down that route at the moment as infection rates climb. It is a concern for the ECB, and President Lagarde made that obvious at last week's policy statement. And it's certainly one reason why, amongst all the central banks we've been talking about today, the ECB is probably amongst the most dovish. It's interesting about looking at some of the more up-to-date survey data. We've had some July consumer sentiment surveys for both Germany and France out over the course of the last few days. They found worries about the Delta variant pushing down expectations about what's going to happen to growth for the second half of the year. And interestingly, particularly against this background of rising inflation, there are some signs now that concerns about increasing inflation is going to hit real incomes, and of course that could depress consumer spending as we go forward. Similarly, business confidence from the likes of the PMI surveys, the overall Eurozone index, that fell to a 5-month low in the provisional data for July. So COVID is certainly still very much an issue as far as policy is concerned for Europe. With regard to last week's policy statement, there was nothing particularly new in terms of interest rates or quantitative easing. But the key point, which is worth noting, was the change to the forward guidance. As we talked about last week, the ECB has this new 2% symmetric inflation target. Crucially, though, in the past, they've talked about needing to meet that target by the end of the forecast period to justify any kind of change in interest rates. What they're talking about now is that inflation has to reach the 2% mark well before the end of the forecast period. That's typically 2 to 3 years or so. So the bottom line to that little lot is it probably defers the time of any rate hike even further into the future. But certainly splits on the governing council. There's no change there. But the bottom line, it does still seem to be that policy as far as the ECB is concerned is going to remain very dovish. The numbers, well, the likes of the PMIs look good. The flash July index, the composite output, came in for July at 60.6, which is a 21-year high, which certainly sounds impressive. But again, as we talked about in previous podcasts, these numbers are currently being biased up by the higher inflation components, both purchasing activity and in particular vendor delivery times, which are biasing up the headline numbers and really presenting a misleadingly bullish overall picture. In terms of growth, Terry's talking up the US economy, certainly second quarter looking pretty good there. For the Eurozone, we'll get the flash second quarter data on Friday. That's expected to be up 1.5% quarter on quarter. So in US terms, a relatively meager 6.1%. Well, that would more than reverse the contraction we saw in the first quarter. That was down 1.2%. So it means the end of the recession as far as Europe's concerned. But do note that GDP for the Eurozone, if the expectations are right, it would still be about 3.5% below where it was at the back end of 2019 before the coronavirus actually arrived. Inflation at the moment is still pretty low as far as the euro is concerned. It's easy to talk up all the potential risks because of the increase we've seen in likes of producer prices and to some extent wages. But by and large, the core rate is still running around about 1% or so, which is one reason why the ECB can continue to operate with such an accommodative policy. Numbers for this Friday will be interesting because they'll be for July, and there are going to be all sorts of distortions, which are probably just quickly worth mentioning. Last year in July, we saw the German government reduce VAT. Now that reduced German inflation by the best part of about 0.8, 0.9 percentage points, but it wasn't reflected in the Eurozone number because there was some delays in summer sales taking place in particularly France and Italy. So it probably means that whatever we see when we get the German July inflation figure out tomorrow, it won't be a particularly good guide to what's going to happen from Europe on Friday. What happened in the Eurozone last year was that inflation actually went up in July, despite the fall in Germany, but then it fell out of bed in August. And it won't surprise me at all if we see the same sort of thing coming through this time round. So that's just something to be aware of. UK, well, over here, there's still a lot of talk about potential for the Bank of England to join, to join the likes of the RBA in finishing quantitative easing at next week's policy meeting. At this stage, I've got to say it's an extremely close call because we've got some officials on the MPC pretty well signalling that they think now the economy is doing well enough that it doesn't justify such an accommodative stance. So they want to see quantitative easing being ended before the current ceiling is actually reached. We've also had some other members suggesting, well, just a minute, we're going to have the end of the likes of the furlough scheme and other fiscal support measures over the course of the next couple of months or so. We should really see what that does to the economy before making adjustments to policy. So it's going to make for an interesting run up into next week's meeting, and we'll talk a little bit more about that next week. But it is worth mentioning that by and large, UK economy doing well. We won't be getting over here the second quarter GDP numbers until where are we? The 12th of August. But just on a basis of what we know from April and March so far, annualized growth in the second quarter could be almost as high as 18%. And that's just assuming a flat number for June, which is unlikely. So there's going to be pressure, I think, on the bank to raise interest rates, or I should say to end its quantitative easing either way. And that's one reason why the pound is trading so strongly at the moment. What else from my side? Quickly round off with Canada. Inflation numbers in Canada moving in the opposite direction to many countries. The July CPI out we had today was down at 3.1%. That's after 3.6% previously. June, I should say. Core rate flat at 2.2%. What does that mean? Well, it probably means that the Bank of Canada is still going to be amongst those central banks which will be looking to taper over the course of coming months. Interest rate hike there, still probably not until at least the middle of next year or so, so behind parts of Brahms countries. But nonetheless, it looks as if they'll be well ahead of what the Federal Reserve will be doing as we go into next year. Okay, that's probably my little lot roundup. Terry, Bron, anything else to chip in before we wind up today's podcast?
Yeah, well, just on Europe, is there has there been much divergent within the Eurozone at the moment? Japan, France, Germany, are they sort of going on at about the same rate, or there's been a bit of a difference in how they're performing at the moment?
I would say they've actually started to become, they're moving more in line with each other now. I guess one of the big issues for the Eurozone, and the fact that at the end of the day, we look at the recovery in Eurozone growth in the second quarter, assuming the numbers are the expectations are at least broadly right, it's still pretty disappointing, I think, compared to what, let's say, markets were expecting at the beginning of this year. Now, the first quarter was really due to underperformance by Germany. We saw a surprisingly sharp decline there. But it looks by and large as if most of the rebounds in the second quarter are going to be a sort of similar order of magnitude. But one aspect, I think, which is worth just reiterating, we talked a little bit about it last week, is that by and large demand across most of Europe is now recovering pretty well. Although we do have some COVID restrictions being reintroduced because of the rise of the Delta variants, retail sales in most countries have picked up very strongly. However, output, or at least output as proxied by industrial production, is lagging well behind because of the problems on the supply side, raw materials, etc., etc. And that in itself is going to potentially make for underlying inflation problems down the road. But I think one good news for the ECB is that there's probably a closer synchronicity between the various countries now than we had perhaps just a couple of months or so ago, which makes, of course, setting policy for the ECB that much easier than it would have been otherwise.
Okay, thanks.
Okie dokie. When in that case, that's probably long enough for us anyway. So let's wrap it up for this week then. So on behalf of Terry, Bran and myself, thanks as always for listening. We'll be back next week. And in the meantime, you can, of course, find all the key market moving data and events listed and analysed in Econoday's exceptionally user-friendly global economic calendar. We'll see you next time. Bye for now.